The market presents a picture of absolute boredom. For weeks, perhaps months, a stock has done nothing. It moves sideways in a tight, frustrating channel. The crowd loses interest. They sell out of sheer impatience and look for excitement elsewhere. And then, one day, it happens. A single price bar erupts from that channel with breathtaking force. It is long, powerful, and decisive. It screams opportunity. But for the uninformed participant, it also screams confusion. The mind races. Is it too late? Am I chasing the top? Is this a trap set by larger players to catch me? This single moment of violent price action, this sudden commitment, creates a paralysis born of uncertainty, a fork in the road where one path leads to potential profit and the other to predictable financial loss. The difference between those two paths is not luck, it is understanding. This event is not random noise. It is a message written in the universal language of price and volume. It is what we call a commitment bar, and it represents a profound shift in the balance of power between supply and demand. To grasp its significance, we must first understand the period of quiet that came before it. That sideways channel, that period of boredom, was not empty time. It was a phase of preparation. Large operators, the smart money, do not buy their entire position at once. Doing so would create a massive price spike, alerting everyone to their intentions and forcing them to pay higher prices. Instead, they operate with stealth. They accumulate their position slowly, quietly, within that trading range. They buy on the small dips, absorbing the shares of impatient sellers. Think of it as a large ship being loaded in a small harbor. The process is slow, methodical, and barely noticeable from the shore. Each share they buy is one less share available for sale later. Over time, they systematically drain the market of available supply within that price zone. The decreasing volume we often see during this phase is the evidence. It's the market getting quieter, a sign that the pool of sellers is running dry. The commitment bar is the moment the loading is complete. The large operators have acquired the line of stock they desired, and now they have no more incentive to keep the price down. In fact, their goal is the exact opposite. They must now move the price up significantly to create a profit on their massive inventory. The commitment bar is the first powerful shove to get the ship out of the harbor and into the open sea. It is an aggressive, intentional act. They are not testing the waters. They are committing their capital to a directional move. The high volume that accompanies this bar is the proof. It represents a surge of professional buying, a coordinated effort to overwhelm any remaining sellers and break free from the gravitational pull of the trading range. It's the market's way of announcing that the period of quiet accumulation is over, and a new period of upward movement, or markup, has begun. The uninformed see a sudden spike. The professional sees the logical conclusion of a lengthy, hidden process. So how do we identify this crucial signal amidst the endless stream of market data? You must train your mind to see the context, not just the single event. First, visualize a period of sideways price action, a trading range. Imagine two horizontal lines, one acting as a ceiling, resistance, and the other as a floor, support. For a significant period, the price has been bouncing between these two lines like a tennis ball. The action is dull, and the volume bars at the bottom of the chart have been getting progressively shorter, like a fading heartbeat. This is the cause being built. Then you look for the commitment bar. It should be a long bar that decisively breaks through the ceiling of that range. Its length should be notably greater than the average bars within the range. Most importantly, it must close near its high. A bar that shoots up but then falls back down to close in the middle is not a commitment. It is a sign of indecision, or worse, a sign of selling pressure at the higher levels. The final piece of the puzzle is the volume. The volume bar corresponding to this commitment bar should be a skyscraper compared to the small buildings of the preceding volume. It should stand out, confirming that this move has immense power and participation behind it. A breakout on low volume is suspicious. A breakout on massive volume is a statement of intent. Now, understanding this pattern is one thing. Acting on it is another entirely. This is where the psychology of Jesse Livermore meets the logic of Richard Wyckoff. The amateur impulse is to jump in immediately, to chase the price as it soars, driven by the fear of missing out. This is often a mistake. A professional operator understands that the market rarely moves in a straight line, and patience is the ultimate virtue. Here is a more structured approach. The setup you are looking for is the established trading range with diminishing volume, followed by the appearance of a clear commitment bar that breaks the resistance on high volume. This is your signal to pay very close attention. The preparation is complete. The trigger for action, however, requires more finesse. An aggressive trader might enter the trade during the final moments of the day if the commitment bar is closing at its absolute peak. This is a high-risk, high-reward entry that assumes the momentum will continue immediately. A more prudent and generally more successful strategy is to wait for the first pullback. After such an explosive move, the market often needs to catch its breath. The price will frequently drift back down to test the level it just broke. That old ceiling, the resistance of the trading range, should now act as a new floor, a point of support. This is a critical test. We want to see this pullback occur on significantly lower volume than the breakout bar. Low volume here tells us there is no significant selling pressure. The sellers are exhausted. The large operators are not participating in this small dip. They are holding their positions. Your entry trigger is when the price holds this new support level and begins to turn back up. This is the last point of support, the safest and most logical place to commit your capital. You are not chasing. You are entering on a confirmed sign of strength after the market has proven its intentions. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original, timeless wisdom, presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Protecting your capital is the first and most important job of any market participant. Before you even think about profit, you must define your risk. Your stop loss is not a suggestion. It is an unbreakable rule. Where does it go? If you take the aggressive entry on the commitment bar itself, your protective stop should be placed below the midpoint of that bar. A true commitment bar should not see its gains cut in half. If it does, the commitment is weak and your premise is likely wrong. If you wisely wait for the pullback to the last point of support, your stop loss goes just below the low of that pullback. If the price breaks that level and falls back inside the old trading range, the breakout has failed. The thesis is invalidated. You must exit the position immediately without hesitation or hope. A small, manageable loss is the price of doing business. Allowing it to turn into a significant drawdown through inaction is a failure of discipline. The market is telling you the breakout was false, and you must listen. Of course, the market is a dynamic environment, not a static textbook example. We must be prepared for variations and potential failures. What if you see a perfect commitment bar, but on the very next day the price reverses violently and closes back inside the trading range? This is a classic bull trap, also known as an upthrust. The breakout was an illusion. The high volume was not a sign of commitment to the upside, but was, in fact, a sign of large-scale distribution. The large operators were not buying. They were selling their inventory to an excited public rushing in at the top. In this scenario, your plan is simple. If you entered, you exit immediately on your stop loss. A failed commitment is one of the most powerful signals that the market is weak and may be headed in the opposite direction. The strong hands have tricked the weak hands into taking the wrong side of the market. Another scenario is when the breakout occurs, but the price does not pull back cleanly to the old resistance level. Instead, it just keeps moving higher day after day. The fear of missing out becomes immense. The temptation to chase it, to throw your plan out the window and just buy at any price, is powerful. This is a test of your discipline. The rules of engagement exist to protect you from your own emotions. If the market does not offer you a low-risk entry, you do not take the trade. Period. There will always be another stock, another setup, another opportunity. Chasing a runaway move is like jumping onto a moving train. You are more likely to get hurt than to get a good seat. A professional waits for the train to pull into the station. If it never does, they simply wait for the next one. Patience preserves capital, and capital is your tool for this business. A third variation is the deep or prolonged pullback. After the commitment bar, the price might meander back down for several days, even dipping slightly below the breakout point, shaking the confidence of those who bought the breakout. This is designed to dislodge traders with weak conviction. Again, the key is to read the volume. If this entire pullback process is happening on light, drying up volume, it is generally constructive. It shows a lack of aggressive selling. However, if the pullback occurs on rising volume, it is a major red flag. It tells you that supply is re-emerging and the breakout is in jeopardy. This is why the stop loss is so critical. It removes the need for you to guess or hope. The price action, combined with volume, will tell you if the environment is safe or if it is time to step aside. Your job is not to predict, but to react to the evidence the market provides. In summary, the commitment bar is far more than just a large price move. It is the culmination of a strategic process of accumulation. It is a declaration by the market's most influential players that a change is underway. Your task is to learn to read this declaration in its proper context. This means identifying the preceding trading range, confirming the breakout with a surge in volume, and observing a strong close near the high of the bar. It means exercising the discipline to wait for a low-risk entry on the subsequent pullback rather than chasing the initial excitement. And it means, above all, honoring your stop loss to protect your capital when the market proves your thesis wrong. This systematic approach transforms trading from a game of chance into a business of probabilities. It removes emotion and replaces it with a logical framework for decision-making. The market is constantly speaking. The commitment bar is one of its loudest and clearest statements. Learning to listen is the foundation of sound speculation. If you wish to understand more about the market's language and the subtle yet powerful forces that drive it, continue to follow this work. The journey of education is the only path to consistency.